Hello everyone. So we are here to present to you about our listening activity discussion about the Enron documentary. But first of all, let us introduce ourselves. We are from Group 5 and I am Ahmad Rozin.
And I am Muhammad Ihsan Rizqullah.
I am Annisa Dwi Syafitri.
I am Irpan Supandi.
And I'm Yasmine Fakhriya.
So let's get started.
The main mistakes made by Enron's leaders. Enron's leaders, including CEO Jeffrey Skilling and CFO Andrei Pastow, use sophisticated accounting tricks to create a misleading picture of the company's financial health. These schemes included Enron created hundreds of offshore shell companies to hide billions of dollars in debt and conceal unprofitable assets. While not inherently illegal, Enron failed to properly disclose those partnerships and exploit them to keep liabilities of its balance sheet, deceiving investors. The company aggressively and improperly used MTM accounting, which which allow it to record project future profits from long-term contracts as current earnings, even if the money had not been received. This inflated revenue and created a large, unsustainable gap between report earning and actual cash flow.
Okay, the main mistake made by Enron leaders mark-to-market accounting. Enron used this technique to count potential money from the future deal as income they already had. This made their books look like incredibly profitable, even though the cash was not actually there. Next, systematic debt hiding. The leadership set up many special purpose entities or SPA, essentially shell companies, to systematic stash away billions in debt and cover up hard losses, keeping it out of the company official balance sheet to fool investors. Greed and arrogance. The company culture was incredibly toxic. The main goal for the leader was pumping up the stock price in the short term to get massive personal bonus. These executives were far more interested in their own wallet than in the actual long-term stability of the company. Misleading investors. Executives repeatedly lied to the public, Wall Street analysts, and their own employees, insisting the company was in fantastic financial shape. They did this while knowing it was secretly collapsing and while they were personally cashing out hundreds of millions in the stock.
How to prevent this fraud? First, maintain independence, which auditors should have refused to provide both auditing and consulting services to same company, as this created a conflict of interest that impaired their professional judgment. Second, uphold ethical standards. Accountants, accountants must refuse to create or condemn false or misleading financial statements. Third, strengthen internal controls. Accountants could have pushed Enron to establish a strong independent internal audit department rather than outsourcing it, which would have would have helped identify fraud early. Fourth, conduct thorough audits. Auditors should have performed more rigorous audits, including forensic audits, to uncover the fraudulent transactions and mispresentation in Enron's financial report. And the last one is challenge management. Accountants should have been more skeptical of management's requests and challenged the use of complex off-balance sheet entities and questionable accounting practices to hide debt.
All right. How accountant could have stopped the fraud? First, maintain true independence. An auditor's primary duty is to the public and investors, not the company paying their bill. They must avoid conflicts of interest, like getting paid huge fees for separate consulting service, which can make them afraid to challenge their client. Second, uphold ethical obligation over others. Internal accountants have a provisional and ethical duty to review directive from executive to manipulate reports. Their loyalty must be to the integrity of the financial statement, not to the manager demanding fraudulent numbers. Third, rejecting deceptive accounting. The auditors had the power to reject the aggressive mark-to-market accounting and the deceptive SPA. Instead of approving this manipulation, they should have applied professional skepticism and reviews to sign off on financial statements they knew were misleading. And fourth, enforce and report on internal controls. Accountants are responsible for ensuring strong internal control exists. When they witness those controls being deliberately bypassed, they have a provisional duty to report those violations directly to the audit committee or regulators.
So, what we learn from Enron is more than just a story about business failure. It's a lesson about ethics and integrity. Enron's collapse reminds us that success built on lies and manipulation can never last. The company appeared profitable, but behind the scenes, they were hiding massive debts through fake cunning. This kind of dishonesty didn't just affect the company's leaders, it caused thousands of employees to lose their jobs and savings. For us, the biggest takeaway is how important honesty and transparency are, especially for accountants and financial professionals. They're the ones who make sure that every number reflects the truth. When they fail to do that, it can destroy trust and the entire organization. So, in short, Enron teaches us that ethics should always come before profit. A company's real strength is built on trust, not on how much money it makes.
All right, that's all from us, everyone. So, hope you enjoy and thank you for watching. Bye bye.